In today's episode of the Daily Brief, I'll talk about two interesting stories. I first talk about SEBI skinning a notorious finfluencer, and finally, I talk about how you shouldn't fear the exchange rate. Welcome back to the Daily Brief show by Zerodha, where our aim is to simplify the biggest news in the financial markets in a way that's one level deeper as compared to news channels. I'm your host Akshara, and today is Monday, 8th December. Coming to the first story. Have you seen The Wolf of Wall Street? If you don't already know, the movie is about a trader named Jordan Belfort who's played by Leonardo DiCaprio. So he recruited many people who knew nothing about the stock market to sell scammy stocks to unsuspecting retail investors. In that process, he built a cult of personality around himself where he promised people to make them rich beyond their wildest dreams. And they took his word as gospel. But most of those promises were false. He got jailed for stock manipulation and mis-selling. And India has a similar, if not same, cases too, like Ketan Parekh and Harshad Mehta. And SEBI is always on a tight watch for such individuals. They have now trained their sights on Avadhut Sathe, a self-proclaimed finance professional who sold stock market education courses. He built a cult around himself with people claiming their fortunes have changed because of his courses. Now, his case is not as serious as the scams mentioned above, which were hardcore stock manipulation cases rather than miseducation. But the cult of personality is common to them. And much like Jordan Belfort, there's a lot of dancing in his events, almost as if they're weddings rather than conferences. But here's the thing. In the stock market, you should be deeply suspicious of such promises and cults. No one, not even the best investors, has a one-size-fits-all magic formula to beat the market consistently and be foolproof. However, much like Godmen, Sathe offered such magic. So, SEBI has taken Avadhut Sathe and his wife Gauri Sathe, the directors of Avadhut Sathe Trading Academy or ASTA, to task, raiding their property earlier this year. We'll break down what they found, but more than the dissection of a potential case of fraud, this is a cautionary tale. Let's dive in. So, first, let's look at their cost of no registration. Avadhut Sathe's scheme boils down to one thing, that he was unregistered with SEBI. See, in order to provide investment advice or even publish official equity research, you must register yourself with SEBI. It's not a very expensive process. You just need to meet certain educational qualifications, pass an exam by the NISM, and meet a minimum level of work experience. But it's the rules that apply after registration that matter the most. After all, you're now a custodian of the Indian capital markets and your word matters to the rest of the market. That means you can't mislead people or run unofficial channels to peddle investment advice. For this reason, there's a list of things SEBI registered investment or research analysts cannot do. That includes running WhatsApp or Telegram stock tip groups or guaranteeing success of any type or advertising selective success stories. Analysts can sell educational courses, but they cannot be mixed with specific stock recommendations. But Asta was found to break each one of those rules. In fact, one might say that being unregistered with SEBI was the foundation of its business model. At the heart of Asta's business are multiple tier courses on how to play the stock market. Many of them have extremely cheesy names. And these courses broke every rule in the book. And here's how. To start with, SEBI seized video recordings of the courses in the raid, and across every course, Sathe or one of the other teachers explained an entire trade, from the stock choice to when and what price to buy. A huge no-no in the eyes of SEBI, which explicitly does not allow live trading sessions in educational courses. It gets worse though. Sathe was also found making stock market predictions in his courses, and if there's anything we know about predictions, is that they're more often wrong than not. To do so in an attempt to influence your own students to trade, especially as an unverified investment advisor, is an extremely shady practice. In fact, Sathe was explicit in his influence, often saying that his trades are good for everyone. SEBI also found him showing his own mark-to-market gains to try and get his students to make those trades. And that influence worked just as intended. SEBI has also found evidence of the participants duplicating Sathe's exact trade at the exact time as him. These offenses are bad enough as it is, and it looks like it couldn't get much worse. But the outcomes of these trades are where this crosses over from mere rule trespassing to a potential case of fraud. No money where the mouth is. Asta has been aggressive in promoting its courses. The most important marketing device it used was testimonials from past students who would credit the supernormal returns they earned to Avadhut Sathe's courses. These students were either homemakers, bankers, or people who worked regular jobs. Doesn't this seem like the easiest way to earn trust? Only if you judged a book by the cover. SEBI found that in case of 5 public testimonials available on YouTube, the actual profit earned by the student was far less than advertised. And actually, of the 5 people, only one had recorded a profit. All the rest bled lakhs of losses in the time period advertised in the testimonial. And this is as obvious and blatant as fraudulent advertising can get. If you zoom out from these testimonials, it becomes clear that Avadhut Sathe has no magic formula for beating the market. For 186 ex-students, SEBI found that in the 6 months after the course completion, 65% of them incurred losses. In total, this entire set of 186 people made a dismal loss of approximately rupees 1.9 crore. What's even more damning is that if the last 2 years are anything to go by, Avadhut Sathe himself wasn't great at trading. SEBI discovered a cumulative loss of over rupees 4 crore in his trading account, while his trading academy also ran a loss of approximately rupees 2 crore. But these losses were more than made up with the total course fees collected over the last 10 years. They served over 4.1 lakh participants who paid them a total of rupees 601 crore. In the end, they did win, but at the cost of their students. Now, some of this is already known. In fact, nearly 2 years ago, based on some preliminary findings, SEBI issued an early warning to Avadhut Sathe to stop misrepresenting things. However, Avadhut Sathe, with his infallible cult, responded with how he's being unfairly targeted. He argued that he could not be classified as a finfluencer because he did not monetize his YouTube or social media channels. He conveniently called himself a victim of regulatory vacuum. Well, with the new information that has come to light, it seems more like a case of it isn't cheating until you get caught. And this order could potentially set a precedent for those who run similar unregistered advisory operations. Now let's look at the penalty. SEBI's order is not final. It doesn't have too many binding directives, and Sathe hasn't yet been legally charged with a crime. But even by those measures, it is strict. SEBI has banned Avadhut Sathe and his wife from dealing in securities in an individual capacity. They're also not allowed to sell off any of their assets in the meantime. Most importantly, SEBI has impounded over rupees 546 crore from Asta, deeming it as unlawful gains received from selling unregistered investment advice. Now, they've not been fully seized, but they're just one step away from there. This money will be put in a fixed deposit account that will be under the watchful eye of SEBI. Since this is an interim order, things could get far worse than it actually is. In fact, the interim order has some complaints for which concrete evidence hasn't been found. One such complaint is that Asta used a 12-year-old in a promotional video, perhaps to showcase that if a 12-year-old can effortlessly trade after a course, so can you. So here's the bottom line. Fundamentally, the stock market is a game where you deal with the fact that you can never know the future for sure. Risk lurks in even the simplest looking trades, and it's always worth being skeptical of those who claim they've 100% mastered risk. Once in a while, capital markets keep getting such figures. Usually, their story is all too common. Have a lot of innocent people believe your supposedly godlike power, behind which are highly suspect practices. These practices stack on top of each other, but such a stack becomes too visible for a regulator not to ignore. And that's when the house of cards begins to crash. Much like Wolf of Wall Street, which made us laugh a lot, the Asta incident has left some funny tidbits, like this jingle.
All for one approval. One for all approval. All for one approval. One for all approval.
But jokes aside, we'd like to restate the importance of investor awareness in light of such incidents. If you want to learn about trading or investing, you can check out Varsity Live, where we teach everything for free without any song and dance. Now coming to the second story. You've probably seen a lot of articles recently on how the USD INR exchange rate crossed the rupees 90 mark. Some breathlessly call this a crisis, but it is not. That figure is considered a psychological barrier, but that's only because it's a nice round figure. Ultimately, though, it's a number like any other. You should understand what's happening, though, and why that number always seems to rise. Currency economics tends to sound very complex. At a broad level, though, it boils down to just two simple things: supply and demand. Every time any money leaves India at an abstract level, it creates a supply of rupees in currency markets. Likewise, every time money enters India, someone demands rupees from currency markets to send to India. The specific mechanism through which these forces play out can be complex, but fundamentally, these two forces alone determine the exchange rate. If there are too many rupees floating around international forex markets without someone having a real need for them, supply exceeds demand, and the value of the rupee falls. Likewise, if a lot of people are hunting for rupees to pay someone in India, but there isn't a lot of it on international markets, demand exceeds supply, and the value of the rupee rises. However, to really understand the dynamics driving demand and supply, we'll need to dive a little deeper. For that, we're looking at an excellent summary of the current situation from MUFG. So here's the current account. One way of tracking all these flows of money is a country's balance of payments. Think of it as a giant diary that records all the money that's moving in and out of a country for whatever reason. Not all these flows behave the same way. Sometimes you send money across borders without any future expectations or strings attached. These are simple payments made for whatever reason, from payments for something you've bought to even scholarships or charitable donations. Crucially, these do not create any assets or future obligations. This is the realm of the current account. Now let's get to the demand supply question. The current account is the simplest, most direct place to see the demand and supply of the rupee. On the one hand, there are many things India buys from the world, like oil, gold, iron, laptops, even subscriptions for services like ChatGPT. Every time an Indian market makes such a purchase, they introduce rupees to the currency markets, creating more supply. At the same time, we sell things to the world, like carpets, spices, medicines, iPhones lately, IT services, and so on. Every time somebody pays an Indian, they create demand for rupees in the currency markets to make those payments. There are other smaller flows too, like an interest payment made by an Indian company for a loan taken abroad, or when an NRI sends money back home from California, and so on. So here are the variables at play. Now, there's a simple way to understand India's long term current account trajectory. As a share of our GDP, our imports are regularly 2 to 3% higher than our exports. And this difference creates a steady current account deficit, which means every year Indians pay out a little more money than they bring in. The supply of the rupee then constantly outstrips demand. But recently, this has become slightly more complex. For one, Trump slapped massive tariffs on Indian imports. As we've covered before, this has been terrible for some pockets of our economy, like textiles or jewelry. Of course, India's exporters aren't sitting idle. They've found new markets to replace the US and are ramping up our exports there. But it's not easy to replace one's largest trading partner. In the aggregate, therefore, people from abroad are buying slightly fewer things than usual from India and are sending less money our way. And the demand for the rupee has fallen. On the other side of the equation, the government just cut GST rates and Indians responded by making a lot of purchases. Some of those purchases were imported. Many others, such as automobiles, were probably made in India but using imported parts. In both cases, some money left India. Our biggest surge in imports, perhaps, was of gold. As we've covered before, this festive season, Indians shook off the shock of high gold prices, accepted them as the new normal, and bought jewelry with the same vigor as ever. In short, Indians have been sending a lot of money abroad. The supply of rupees has grown, and with it, the difference between supply and demand has grown too. Now let's talk about the capital account. So there's another facet to a country's balance of payments. Sometimes money comes into our borders but with an obligation attached. It could be to purchase an asset. For instance, a foreigner buying a flat in an Indian society. That money could create some other sort of claim, like money that a foreign bank has loaned to an Indian, expecting that it'll be paid back. This is money that comes in, but it isn't something we can take for granted. The person sending the money into India either gets to own something in return or expects to be paid back later. If our current account alone determined our exchange rate, our deficit would have disappeared a long time ago. After all, if more payments constantly leave the country than come in, to anyone outside India, rupees keep becoming less useful. That should pull its value down. And if our money becomes less valuable, it's much harder for us to buy things from abroad, while outsiders get a discount on anything they buy from India. So, in theory, then, the imbalance between our imports and exports should quickly evaporate. A big reason that hasn't happened, and the reason we're constantly able to make those extra purchases, is all the money flowing into our capital account. Coming to long term investments. Any investor putting money into India, in a broad sense, creates demand for rupees in currency markets, which are then invested into the country. For decades now, India has regularly drawn a lot of investment from foreign countries, and this has created a constant source of demand for the rupee. Of late, though, there's a steady stream of supply to balance this out. This is the outcome of two trends. One, foreign investors are cashing out on their investments. Every time a large foreign PE fund sells their shares in an IPO, for instance, they take rupees from investors and introduce them into currency markets. Now, this isn't a bad thing. Foreign investment only comes into India because people hope to eventually make a profit. If nobody could cash out, nobody would invest either. But temporarily, that adds to the supply of rupees. Two, as we've occasionally covered, Indians are making more foreign investments than ever. Again, that isn't a bad thing. A successful foreign investment only enriches India, both by bringing in returns and by introducing us to new ideas and know how. But this too adds to the international supply of rupees. Net net, these two trends have resulted in a slight decline in investors' demand for rupees. For brief periods, in fact, this supply even outstripped demand, pushing the rupee down rather than propping it up. Now let's talk about betting on India's markets. Sometimes foreign investors don't actually want a long term bet on a specific Indian business or asset. Sometimes they're simply taking bets on India's financial markets in all the stocks, bonds, mutual funds, and derivatives we have to offer. These are called foreign portfolio investments, and they come in all forms. They could look like the exciting high wire maneuvers by hedge funds like Jane Street, but these could also just be boring foreign funds parking their money in a basket of debt securities. The principles stay the same though. When they put money into India, they create demand for the rupee. When they pull out, which is much easier when you're only dealing with financial markets, they create supply. Late in 2023, Indian bonds were added into JP Morgan's index of government bonds from emerging markets, and this brought a rush of foreign portfolio money into India. Over the last year, though, foreign investors have been scared away from Indian equities. There have been many points where foreign equity investors have sold their holdings much faster than foreign debt investors have acquired them. And this could be for many reasons, including the simple fact that investors across the world are terrified by the world's current trajectory and are taking less risk than before. Either way, currently, Indian equity markets don't have a lot of interest from foreign portfolio investors, and that has surpassed what is otherwise a massive engine of demand for the rupee. Now let's get to the confounding factors: central banks, liquidity, and more. So let's put all of this together. There's a constant outflow of money from India because our imports and exports aren't perfectly balanced. With tariffs on one end and GST cuts on the other, that skew has only grown in the recent past. Ideally, this would be balanced with capital flows coming into the country. But right now, people are cashing out of their Indian investments or are investing abroad, and portfolio investors are cooling on Indian equities. So, what's the result? For now, rupee supply internationally is higher than its demand. Naturally, the rupee has fallen. That's the heart of what's driving our exchange rate. And there are a few things that can skew things a little. Like anywhere else in finance, there are many other reasons that people approach a currency market, from hedging their exposure to foreign currencies to simply taking bets on where things might go next. This skews the simple demand and supply picture we've painted. So, the RBI is the biggest whale in international rupee trading. It can single handedly move the market. When there's a lot of international interest in the rupee, it tends to hoard foreign exchange as reserves. And later, when the rupee is under pressure, it dumps those reserves to buy rupees, creating a flood of fresh demand. The RBI lets the rupee move along with the market, but in a slow crawl. Now, a lot of the rupee's attractiveness comes from the repo rate the RBI sets. The higher the rates are, the better the returns you're likely to get on any rupee denominated asset, and the more it's in demand. The RBI's recent rate cut, for instance, could make the rupee slightly less attractive to hold, putting further downward pressure on its price. The liquidity in our banking system, meanwhile, shapes how easy it is to sell or borrow rupees. A more liquid rupee is a rupee high in supply and that can erode its value. So here's what you should expect. It doesn't look like the rupee will recover soon. If MUFG is to be believed, given the GDP cuts, Indians are in no mood to pause their buying spree. By its forecasts, our current account deficit will probably widen in the coming months, even assuming that the US will soon cut tariffs on our exports. Investors, meanwhile, don't seem to be warming up to India anytime soon. With the most recent rate cut, the rupee could become less attractive. But there are signs to be hopeful. For one, the markets aren't freaking out. If anything, they're rather sanguine about what's happening. And if anything, the rupee looks unusually cheap when compared to other international currencies, a sign that it might regain some strength over time. More importantly, though, short term price fluctuations are just noise. The bigger question is, how do the fundamentals of the rupee look? There's distinct good news. The world's recent volatility has pushed our government into action and it's unleashed wide reaching reforms to everything from labor markets to import restrictions. And since the rupee seems to have fairly solid foundations, the fact that we've crossed the 90 rupee threshold shouldn't bother you. Now, coming to the tidbits. Reliance has begun preparing the draft prospectus for a long awaited Geo Platforms IPO, Bloomberg reports. The listing is expected to be India's biggest ever, though timelines remain open. Work has started quietly as markets turn more favorable for large tech floats. Coming to the next tidbit. Meta plans to slash next year's Metaverse Reality Labs budget by 30%, with layoffs possible as early as January. Most cuts will hit VR and Horizon Worlds despite earlier optimism from leadership. Reality Labs has already racked up $70 plus billion in losses, and investors want Zuckerberg to redirect cash toward AI. Coming to the final tidbit, Adani and Hindalco are evaluating the purchase of Peruvian copper assets as global demand surges with the clean energy transition. India's copper needs are set to triple by 2030, and both groups are scouting overseas mines to secure long term supply. You can check out all the links in the description. That's all the news I have for you. Thank you so much for watching, and see you in the next one.
Disclaimer: this content is for informational purposes only. None of the stocks, brands, or products mentioned are recommendations or endorsements.